Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Thursday, and we are bringing back the guys from Convoy. How you guys doing?
Good. How are you?
I'm doing very, very well. Just real quick, introduce yourself to the audience. You guys are coming back for your third visit, so you will be coming back every other week, but let's do one more introduction. Who's who in the zoo?
I'm Jonathan. I'm one of the owners of Convoy, obviously. And
I'm Dustin.
Very cool, guys. I just want to make sure we do that so the audience gets to know who you are, part of the family. So we're going to do one long interview today, and we're basically going to be talking about the market, right? We came together, let's call it a month ago, and 30 days later, the non-QM space is different. So why don't we talk about some market adjustments, Wall Street, those kinds of things, just so people understand what is going on in the world.
Yeah, it's changing at speeds we've honestly never seen before in terms of, the programs and the rates that are being offered. And what really happened is in the past month, I'd say 2 months, we've seen the non-QM world, these 40-year interest onlys, these no income requirement loans have really changed to the point of about, I want to say 1.5 to 1.75% in that short time period when, we didn't see rates move at all from March of 2020 till January of 2022, like didn't move.
That's it. And again, that people that are watching my channel know that we speak to Matt, the mortgage guys, on Wednesdays. And as we talk to him, rates can move 2 or 3 times a day. The non-QM space did not move for about 20 months.
That's correct.
And then it moved. And just to educate the folks, why does that happen? Why does the non-QM space kind of have these, I don't know, stairs, elevators, whatever you want to call it, versus, I don't know, the daily gyrations of the mortgage market? You got a color on why that's different?
Of course.
yeah, so I mean, with these non-QM loans, that basically how these lenders will sell it, because every loan is basically sold on the secondary, right? Almost every. So what they'll do is they'll package it up and put it on Wall Street. And obviously, like we talked about in the first video, there's people like Goldman Sachs and, big institutional people that purchase these loans. And, they go off of demand to purchase for these products that they put out in the market. Recently, what happened was obviously, and this happens, I assume, pretty often when there's a longer break for the holidays at the end of the year, and then, bankers come back and they realize, oh shoot, the market's different. Now,
it's different, Mom.
Yeah. Especially after coming out from vacation. And, what we're hearing now is obviously, because the investor sentiment has changed, the lenders went to market with a bunch of loans. We're hearing probably in the number of like 4 billion or so packaged up. They went to market and Wall Street basically said, no, we can't buy. So if there's no buyers for these loans, then obviously the lenders can't hold on to these loans on their lines and all of that, and that causes issues. So, the up and down on the rates, not down as much, but more ups recently, have been a lot due to the fact that Wall Street said that, hey, we're basically not going to buy any, weighted average coupon is what they call it, WAC, under 5 to 6%.
There you go.
And, obviously we're still doing loans below that just because we have a lot of volume. But, the average right now with everyone across the board is, hey, if the rate's under 5 or, in that area, they're not really going to touch it. So it's kind of an exception-based thing now, which obviously we have exception to do, but, the whole conventional 30-year fixed even market has moved up to like 4.625, 4.75 and above.
Oh, no, you're absolutely right. The mortgage market, again, that's why this channel exists. We talk to all different providers. It's moved up for everybody. All right. Again, I'm not a lender, but, vocabulary becomes pretty consistent, right? The floor rate, or what I'll call the minimum, it adjusted for everybody. I got 3 or 4 phone calls in like I don't know, it was like a 36-hour period. It's like, oh, no longer sub 4. And oh, by the way, it didn't even stay in the 4s. It jumped the 4s and landed in the 5s.
Yeah.
So yeah, this is all because of Wall Street. Again, I step back as a non-participant and go, what happened? Well, I think Wall Street finally is a believer that inflation is real, right? Why would you accept, I don't know, I'll call it 4% when inflation you think might be running at 7, 8, 10, 12, 15, whatever you think it is, right? You're going to want greater security. And what that usually means is higher rates. Again, my simple view.
Yeah. I think they come out tomorrow, right? Inflation numbers. I'm curious to see what those are at.
Yeah.
To see what's going on right now.
Yeah, the PCE and the real CPI I think is a week after next, and given what else is going on in the geopolitical world, that some oil and gas, oil jumped to 100. It's likely not going to get better in the short term, unfortunately. But it's funny when there's a race to cash. I don't know. I'm sure you guys have seen it. The audience probably hasn't, but the 10-year Treasury is down big today.
What are we at right now?
I think it broke 1.9. It may be above that right now. I saw 1.88 earlier today.
Yeah, it opened there and it broke back. I think it came back up a little bit.
Okay.
But,
yes, sub 2.
I know. But I mean, the thing is with, unfortunately, the lenders are very quick to adjust rates up. They're not as quick to adjust rates down. So a lot of people that are the bonds being like, this is where mortgage rates follow. I mean, typically kind of, but like at the same time, there's a correlation that doesn't exist at the same time, because mortgage rates are also set by investors. Correct. Right? And they're the ones that make the rate sheets. If they want to pass the savings on to the borrowers, and they can, but they don't have to if they need a hedge against whatever. Yeah.
And this again is one of those knee-jerk reactions. I would expect Matt, the mortgage guy, to see some better prices today, but again, he adjusts daily, sometimes several times a day. Non-QM space, again, we just said was the same for 20 months. You're not going to have daily gyrations. And what I think most people watching this needs to appreciate is the cost of money is higher. And frankly, it will be higher the rest of the year. I think, my opinion only, the non-QM space will not see sub 4% rates in the next decade. My opinion only.
I would, I would agree with that.
Yeah. Okay. Yeah.
We can't foresee the future, but that's pretty safe given how low we've been for so long.
Yeah. I mean, the Fed came out, it was unnatural. I think we had artificially low rates for 20 months, non-QM and Matt, the mortgage guy. I think the Fed was buying $120 billion in goodies. They were digging a $9 trillion balance sheet, 9.1. They were the buyer. So of course rates were low. Yeah. Now they're stepping back, not only saying not going to buy, but potentially sell. Woo! I don't think we've seen the end of higher rates, in my opinion.
Yeah, I would agree. And I mean, this is kind of, I think, reminiscent of when COVID first started back in, January, February, March of 2020, rates kind of did the same thing. And I'm sure you saw it.
Oh, yeah.
Overnight, within the 3-month period, though, this is a lot bigger shift, in rates because it was within a month. But, that over the 3-month period there, like lenders stopped lending.
No, I mean, I had, again, I talked to thousands of people, right? I had people emailing me that were a day away from closing, that the lender wouldn't release the funds. They just froze.
Yeah. So, I mean, we're not there, which is good. And I think the liquidity of the banks and also just, the lenders in general, I think help. And it's kind of I think we're expecting non-QM to actually grow this year in terms of transaction wise, just because Fannie Mae and Freddie Mac are just getting so heavy on their adjustments and all the different things they're trying to do to slow people down.
Exactly. I agree.
Especially in the investment field, and now the difference between conventional 30-year and, that we're looking at, it's not that much. And if you were to take, a 40-year fixed, let's say, over for an investment property over a 30-year conventional, it's like, it's kind of a no-brainer if you have to stretch it out that far. That's cool.
Yeah, and that's where I wanted to go next, because we talked about the reality, cost of capital is up. It maybe makes some deals a little tighter. But what I'm going to say about the non-QM space, and this happens in all markets, but we'll talk because this is non-QM discussion. What's going to happen is you, meaning the industry and Convoy, obviously, you're just going to have different products created, because what's going to happen is you are going to find those corner cases that Fannie and Freddie aren't serving or have become onerous to deal with. And I suspect, I was going to say this earlier, you just said it, the non-QM space is going to do more transactions and more volume in total dollars this year than last year. And it's not even going to be close. It'll be up 30% or something. It's going to be significant. And part of that's because you're more flexible. You listen to the market, you know what's going on, and you can create new products. You just talked about a 40-year truly fixed. We talked a month ago, it was, 10-year IO and 30-year fixed after, thus 40 years. You just dropped a bomb that I'm not sure everybody picked up on, that you can do 40-year amortized fixed loans now. Did I hear that right?
That's correct. I mean, it's something that we kind of touched on when we first spoke a month ago, that, with home prices, I think we saw the numbers come out this morning. Like Goldman's expecting home prices to go up 16% again in 2022.
Yeah, it's crazy.
And affordability right now, the only way you're going to get into a home, price market, like it all depends where you live, of course, but
Sure.
a 40-year fix is the only way you're going to be able to get people that are renting right now to become homeowners, which, we obviously want, but it's I don't know if it's something that Fannie and, the FHFA is going to actually do very soon. I wouldn't be surprised if.
So let's just have this discussion. A 40-year fixed rate mortgage is coming to Fannie and Freddie and FHFA, but it will be late. It will always be late. They're slow to market. The prices will already be up. So again, you're going to do a 40-year truly fixed rate mortgage for investors and homeowners. I want to make sure we hit that, because this is not only non-QM for investors. You are doing, or I don't want to put words in your mouth. Will you do 40-year fixed for homeowners as well?
Yeah, it's for both. It's owner occupied. You can get a 40-year amortized principal and interest for 40 years, or investment. The only difference is, like we've touched on, is that if it's an owner occupied, property, we're going to look at some sort of personal income. Investment properties, we're
it's the asset.
Fortunately, yeah, exactly.
Yeah, and that's the same across the board, right? Non-QM space is about the asset, home ownership, you're going to be your credit, your income, reserves, all of that will be part of it. But damn, you just heard you can get 40-year fixed rate money. We'll hit it again at the end of the video. How do you want people to reach out? Because somebody just heard that and they want to reach out.
You can email us at privateclient@convoyhomeloans.com.
And I will put that in the show notes below, first line, so people have it in case they missed it. I haven't done the math, but I'm sure you guys have had. What is the payment difference? A 30-year fixed, I don't know, at some dollar, are we talking hundreds of dollars a month? Have you done the math?
We can do it right now together. Why won't we? I mean, I priced a couple out actually yesterday, and it was on I want to say it was a $1.5 million deal.
All right.
And the difference, let's see here. I mean, we are talking, on principal and interest.
Yeah. Yeah.
The difference on a $1.5 million deal is about $900 cheaper.
Oh, wow.
Going 40, year fix versus 30-year fix. That's not as cheap as obviously the 40-year IO we've spoken about, but still the fact that now somebody can afford a payment that's like we were speaking about on a $1.5 million deal, it's $900 cheaper. There's a lot more people in the market that can now afford a home with these,
afford a home, or because again, one of the things that we talk about on Thursday, I have what I call the three amigos. It's three other investors together. We own like 350 units or something. And both of them say if they had the option, they would only get 40-year. They would prefer 40-year fixed, which now you're giving them, because they're like, I do this for cash flow, right? You can talk about mortgage pay down all you want, but I want cash flow. So for them it might be a $500,000. So if it's the same ratio, that's $300 a month in cash flow, $3,600 a year, spendable cash flow versus mortgage pay down, which you can't get because you're not going to extract it, especially in a rising rate environment. So lots of people are going to be looking at this, and what's going to happen is 40-year mortgages will become the standard. Will it be this year, next year, the year after? But the math says when it becomes a standard, prices will adjust about 12%.
I mean, those are the numbers right there. You can see why, because people can now, just like I think we touched on it last time.
Yeah.
Buy an SUV now and get a 8-year payment, whether $80,000 cars.
It's all payment. I mean, yeah, just this morning, a CNBC article said even used cars now are out to 7. It used to be only new cars. Now used cars out to 7 years. It's all about the payment. 40 years are coming. It's good. Fannie and Freddie will be late. So if you're looking to get 40-year money, you want to go early, you need to reach out to Convoy. We'll put the email address below. What else are you guys seeing in the world? How has the one rental at a time community been? Have a lot of people reached out, or has it just been crickets?
No, it's been great.
Yeah, I mean, to be honest, your community is very, very well educated, and I think you do a great job of keeping them educated as well. And they do a lot of research themselves. So, we've spoken to a lot of community members that have, kind of obviously physically been in the shift with us, right? Yes. So with them, they've been very understanding in terms of like, hey, this is where the market's going. Like, I get. They get it, right? It's not like a conversation that we need to have with an inexperienced investor where we're like, hey, the rates aren't where they used to be, and what I said in the video. And they're like, what do you mean it's not the same? I'm getting advertisements online from
Rocket,
whoever,
rocket ship.
Whoever, right? Or the depot saying that my investment property, I can actually get a 3.625. And I'm like, well, I mean, good luck, but I mean, investors in your community that we've spoken to have really been understanding in terms of like, do the numbers still make sense? And then also, if it does make sense, it's like they understand where the market is, and that's what's happening. We can't control that, obviously. They can't control that. Nobody can control that. So they've been great.
Awesome.
But obviously, in terms of like programs changing and whatnot, which is kind of the biggest thing, is kind of touching base back on Wall Street sentiment and appetite. Now, I mean, the 40-year IO product, we have lenders that are starting to try to move away from it, but we also have lenders that are staying with it. In fact, some lenders are adding it on. So we have lenders that are, they found buyers then, right? So they have, they're adding it on, and then we year IO as well, still available, and again, the 40-year fixed. So there's a lot of different options to finance and make a property and a deal work in terms of cash flow. And if you're going for a business purpose wise, like, the three amigos said, if they wanted a 40-year to get the cash flow and, continue to cycle the money, then they can do so without an issue.
One rental at a time is about cash flow. I mean, appreciation is great. Mortgage pay down is great. But Dion, man, Dion's like, do 40-year all day long, right? And I think that just makes a ton of sense. And again, we're talking all 50 states for investors. You have many states for home ownership. What about self-employed? Self-employed has been really something that's been ignored by Fannie and Freddie, and it still is. Talk about being self-employed. Is that something where you guys help?
Yeah, we do a lot of them actually. And in the with Fannie, what was nice is since, COVID hit, they made it impossible.
Crazy.
Yeah, you had to have audit, profit and loss and balance sheets and all of that. They did remove at least that condition recently, which makes it
a little bit better. It goes from a 10 to like a 9 on the scale.
But the self-employed clients that we have are utilizing our bank statement program because it's just a lot easier. We'll look at your deposits. They got to be business deposits, but we have one program right now that it's crazy. It's a 3-month bank statement program if you're self-employed.
Oh, wow.
We need to have a P&L attached to it, but typically, the most common over the past couple of years has been a 12-month.
Right.
We'll get it done on a 3-month bank statement program, and that's pretty insane in my opinion.
Absolutely. Well, one of the things I want to tell the one rental at a time community right here, right now is if you're looking at deals and you're thinking some of these products make sense, I strongly suggest reaching out to these guys, initiating a conversation, because the non-QM space is adjusting. You hopefully heard that in the beginning. It didn't move for 20 months. There's been almost like an earthquake. It's the best analogy I have because I live in California. So when they happen, you pay attention, and then they're over for years. But there's a tectonic shift, and now's the time to reach out, have a conversation, see if it makes sense. A lot more products, a lot more flexibility. In my opinion, more flexibility coming, because my suspicion is you guys will have options in 2 months that you don't have today, and you don't even know what they're going to be. And probably you guys are probably working on them already. You just can't announce them. I get it. And then lastly, the non-QM space is going to see a lot more business because they're going to go 40 years fixed, like we just talked about. You have bank statement loans. It's going to be the way a lot of investors get done, because I think Fannie and Freddie is going to be focused on owner occ, kind of the first-time home buyer, where you guys serve a different need, and your rates are. It's not like hard money where you're 8 points above Fannie Freddie. You're like within a whisper. So, how do you want them to reach out one more time?
Reach out to email privateclient@convoyhomeloans.com.
And that's private client, one word, no spaces, no dots.
Correct.
Private client.
privateclient@convoyhomeloans.com.
Very cool. Any closing thoughts? Anything you want to talk about the real estate market? Any other data you want to share as we wrap up this session?
We could go on and on, but I know you're busy, we're busy. A couple things I did want to point out is John alluded to it earlier, how this is kind of reminiscent of when COVID hit and lending kind of came to a halt. I'm not saying that lending's coming to a halt right now, but we are seeing in the non-QM space, because he mentioned that they've got about $4 billion worth of loans that they can't sell right now, and as a result, they're very selective on how many loans they want to close. And because of that, we're seeing conditions, when clients provide conditions and when underwriters review them, we used to get them done in a day or two. Now a very simple condition may take 7 or 8 days.
Okay, so timing's a little longer.
Yeah, things are going a lot slower because of the fact the funding issues that we're having on the back end of getting these loans sold. But I did read one other article too that I thought was interesting, that I think will spur at least these first-time home buyers and what we'll see in pricing. I think it was I forget what poll went out, but in 2022, I think 80% of renters right now are planning on buying a home.
Oh wow.
Pardon me, 80% are planning on moving. 40%
moving. Yeah. That makes more sense. Yeah.
So we'll see, I think we're going to see, as we have touched on, a lot of affordability programs continue to be rolled out.
And we have some more exciting things, up our sleeves that we'll talk about soon for, the non-QM space, and also just in general, because we have a lot of different lenders we work with. So, that's to save it for future videos on explanations. But
cool.
if any of your viewers feel like they have anything that's kind of a particular situation, we'd love for them to reach out and just speak with one of us, because Dustin and I have been personally handling and speaking to a lot of the community members ourselves, rather than the loan officers in-house. So
I appreciate that.
Yeah, we've been trying to do as much VIP treatment as we can, and we'll continue to do so.
Very cool. Well, I appreciate you guys. We will be talking in another couple of weeks. This video will be up later today. Thanks, guys.
Thanks,
you.
Mike. Bye.